Hello, on today's edition of The Final Bar, my guest is Dana Lyons. He's the founder and editor of the Lyons Share Report. Some really good long-term charts of the S&P 500, giving a bit of an objective, an upside objective as to where the S&P might have been topping out for good reason. We'll also talk about the nice recovery rally we've had today after yesterday's sell-off. What does that mean for the long-term picture? We're going to open the Final Bar mailbag and answer your questions as well. So, ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today. Every day after the close, love to take a look at the charts, how they've evolved today, how that connects to the long-term trends. My guest coming up in a little bit, Dana Lyons, has sent a couple really interesting charts, really putting the rally that's led up to this last couple weeks into proper context about where we're at relative to some long-term objectives in the S&P. It will be very interesting to hear his take on where we go from here, right, given the sell-off of the last couple days. So quite a bounce today, quite a recovery. I think yesterday to today, it's sort of like the tale of two markets. Is it the panic, oh my gosh, the world's ending, horrible viral concerns yesterday? Or is it that things aren't too bad, earnings are pretty good, Apple's reporting after the close, how bad can it be day today? And to be honest, the answer is probably somewhere in the middle. But why does a day like this happen today, right? I thought things were so bad yesterday. It's very easy when you see something like tech up 2% today to think, okay, that was it, we're fine. Remember, the market always moves in expectations. It's all about what we think could happen and then what's priced into the market, right? So it's not about when events happen. It's not about when the world changes. It's when expectations change. So when people are nervous, the market tends to sell off a little bit. When people feel less nervous or more confident, kind of comes back. Now, what's happening right now is you're mixing that, the fear of all the things that are happening, all the news flow, with the fear of missing out on this huge uptrend. And anyone that hasn't been in stocks, that all of a sudden gets stocks at a 2% bargain because the market came off a little bit, is feeling pretty good today, sort of jumping in at the lows and riding it higher. So a lot of really interesting charts to unpack as we go through the markets. But I did want to get to what the other events that we have coming up, some really good content on this show, but also on StockCharts TV. So tomorrow, on January 29th, we're actually releasing our first documentary-style presentation. This is our interview with Ralph Acampora called 50 Years on Wall Street. I just looked at the final version of it this morning, and I tell you, you're really going to be excited to see it. It's a fantastic description of a wonderful career on Wall Street of Ralph's, but also the benefits of data visualization and technical analysis. Next week, the Final Bar will be on the road. We're going to be in Atlanta doing some interviews. We're also going to be down at the Money Show in Orlando. So we're going to be capturing some really good interviews, some great content from some market experts, which we'll be very excited to share with you in the coming weeks, coming months. And then if you'd mark down on February 13th, coming up in a couple weeks, we're going to do our first YouTube Live Q&A. We're planning on doing a weekly Q&A session on YouTube, sitting down, looking at some charts, and then answering your questions. So sign up and subscribe to our channel to get an alert when we go live with that on the 13th. Let's, however, get to the market recap. So, as I mentioned in the introduction, this is sort of the tale of two markets, right? I mean, where are we at? Is it the horrible world is ending, life is a disaster, oh no, how low is this going to go from yesterday? Or is it the things are just fine and companies are doing okay that we saw today? And again, I think, remember, the market is not one day, it's not 1 minute, it's not one news event. It is a string of moments, a string of days, a string of news events over time, and how people react to those things. And as I mentioned in the last couple of days, just with all the news flow, it's all about expectations. So yesterday there was this, fear, this anxiety that things would get climactically worse. And even though a lot of the news headlines have been, continuing to get worse, it's not like we've had dramatically better news headlines today relative to sort of the viral outbreak, that sort of theme coming out of China, but it's all just how bad we think things could get, how that's going to impact companies and their ability to keep growing and trends to continue. So from a technical perspective, how do we put this in a proper context? Well, as I've always said, an uptrend is a series of higher highs and higher lows, and as long as that pattern continues, then the trend is positive. Again, not a judgment call, that's more by definition. So what we've been keying in on is that 3210 level. That's the low from the end of December, beginning of January. In my opinion, as long as we remain above there, we're doing okay. What's happened in the last 48 hours, though, is we've almost established a bit of a higher low. So now the new level, the new line in the sand, 3230. So as long as we remain above that, at some point we will we will come back and either retest those levels or we'll establish a new higher low. And again, it's all about where we're at relative to those previous pullbacks. And again, as long as a pullback remains in this uptrend, the trend is positive, the foot should be on the accelerator. Mentally, overall, the bullish trend is intact. When that changes, that's when you really have to start to be concerned. So again, in my opinion, all eyes have been on 3210, or should have been, and I think now 3230 is a really important level to watch. Are we able to hold that on any sort of pullback in the remainder of the week? Let's go back to the member dashboard, look at what's happened. So the S&P here up 1%. Again, a lot of that came in the first hour of trading. Since then, a little bit higher. We pulled back a little bit going into the close. Small caps, mid caps also up, but small caps up the least, up about 0.8%. So a little less than small, large, and mid, but overall, all in very good shape. Technology back in a leadership position. So this is feeling more like the traditional bull market leadership picture, right? With tech, communication services, financials, all doing very well, all outperforming. That's good. On the downside, you have staples, real estate, utilities. Now, again, remember, with all of these things, we're now deep in the middle of earnings. So you have, Starbucks, Apple, all these companies reporting. So there are a lot of things, a lot of headlines, a lot of events that could cause individual sectors to fluctuate. It's not just a macro call. It's all about those individual companies and how they roll up into the broad market. But again, today in a vacuum, pretty positive. Overall, you see more leadership where it should be. In terms of global ETFs, you had a couple that were up pretty good, actually. Italy, Mexico, Brazil up 1, 2, 3. Brazil is an interesting one because it's very much tied to the commodity complex. Commodities have been so difficult recently. Really pulling back, and oil has been one of the worst charts out there in terms of going from pretty good to pretty bad. On the downside, you have a lot of Asia-related markets, and again, that's probably going to continue until all of the news flow, all of the nerves about the viral outbreak are sort of contained, or until we move on from that in some meaningful way. So not surprising to see Hong Kong, some of the China ETFs down there at the bottom. India as well. India's been an interesting one that's been a bit of an outlier, actually, looking different than others. So interesting to see it on the lower end of the return list today. In terms of groups that were up, you have a group within materials, non-ferrous metals up the most, but coming out of a very depressed position. I'm much more interested in things that have held up very nicely. So something like computer hardware, again, leading out of the lows is pretty interesting. Home builders have been just a fantastic set of charts, and home construction, one of the top groups, semiconductors as well. So the top 10 is filled with some of the traditional offense that would make sense in sort of in a bullish phase. At the bottom, you have a lot of material. So gold miners, mining stocks, aluminum. These were groups that had been doing well when the market corrected, but now back again at the lower end of it. So that's certainly a risk off versus risk on one day to the next. And again, as much as we talk about the daily returns, I have to remind you the point of bringing those up is just to help you think of charts that you should be looking at. This, what I'm just pointing out on the intraday return list, is not the end of the story. That is the beginning of the story. Look at the charts and really try to understand the long-term themes and how they've evolved. Actually, one more thing. Notice pharmaceuticals on the bottom. You have some pharma names that actually struggle. Pfizer came out with earnings, a little disappointing, and so the stock down pretty significantly. That's dragging that group down as well. Wanted to introduce the mystery chart. This is a familiar topic to many of you. I like to take a chart, cover up the ticker, have you guess what it is, and the question is, what is this chart? My only hint to you is this is a security traded in the U.S. It's a U.S. listed security, but that is the extent of it. You can see a daily price for the last year or so. You can see the RSI, and you can see the relative performance to the SPY, to the spiders. So please put in your guesses in the chat, the Q&A segment on the screen for StockCharts TV. Let me know what you think this is. Later in the show, I'll unveil what it is, why it's an important chart to pay attention to right now. Let's get to our next segment. However, we're going to go to the final bar mailbag. So what I love to do is answer your questions. You can keep questions coming to us at any point. Just shoot us an email, thefinalbar@stockcharts.com. Also appreciate your feedback on the show. You guys have done such a great job sending questions to me that I've really enjoyed reviewing them, answering many of them on the air, writing back to some of you if we can't get to you. But please keep the questions coming. Also on Twitter @FinalBarSCTV. Either of those ways we will get them. Or during the show, put them in the Q&A, and we'll make sure that we consider them for a future show. I was a little aggressive. My wife told me, David, you need to do less questions during the mailbag. So, okay, honey, I will back off just a touch. We're going to try to aim for 3 here for this segment. Question number 1. Our guest yesterday was Mark Ungewitter, and he said, the question said, the charts from Mark were interesting. Thought a lot about John Murphy, Martin Pring's books, specifically talking about cycles. There was sort of a cyclical nature to what I was talking about with our guest yesterday. And just thinking about the cyclical nature, in particular asking about the kitchen cycle, which if you're not sure is the 4-year cycle, the 10-year cycle, the Kondratiev wave, which is a very long-term cycle, inflation, deflation, all the different ways we can look at things cyclically. So my short answer to that is that's a great idea. I have a couple people in mind that are really good at cyclical analysis, and also the Kondratiev wave, which is more of a long-term, very long-term, I'm talking 50-plus year cycle, looking at different seasons and how the interest rate environment, inflationary environment all sort of relates to, market phases. I'm gonna think of some people to bring on. If you have any suggestions of analysts, experts, people on social media that do a great job with cycles, shoot them to me over email. I'd love to take a look and see if it's someone we could bring on, but I'll definitely make sure we address the topic. I did want to point out Martin Pring does contribute a lot of really good content through StockCharts and through StockCharts TV. One of his monthly posts, which was from the beginning of the year on January 3rd, if you go to our articles page, you'll see his monthly market roundup video, which actually touched on some cycles. And if you go to our YouTube channel for StockCharts, you'll see actually the replay of that interview. And so it's called Bull Market Structure Continues to Develop, and he deals with the business cycle, sort of the idealized business cycle, about how the current charts relate to that idealized cycle. So that is my gift to you now. Martin Pring did a really good job at the beginning of the month, sort of describing where we're at relative to those long-term cycles. But I will do some thinking, and we'll come up with some other guests to bring on to answer those questions. So thanks for that suggestion on more cycle content. The second question, which included a chart, which I appreciate, it was really interesting to look at how you were trying to visualize things. And I'm going to summarize because it was a well-worded but a little bit lengthy question, talking about a divergence between the advanced decline issues and advanced decline volume. And this is the chart that you sent. So this is looking at advancers minus decliners for the New York Stock Exchange, advancers minus decliners volume on the New York Stock Exchange. So what I would call up-down volume. How many stocks, volume on up stocks versus volume on down stocks. And the question was, I'm seeing this divergence where you have an up day, you have an increase in advancers decliners, but a decrease in advancers declining volume. So question number 1, is that meaningful, and how? Question number 2, why would that happen? How could that happen where there could be an increase in advancers, more advancers than decliners, but then a decrease in up-down volume? How does that make sense? So let me explain, and I will try to answer the questions on the chart, then I'll show you the chart that I would use to analyze this as well. Number 1, this is a 15-minute chart. So it's an intraday chart looking at the last 2 weeks of trading. So it's very short term. And I'm looking at the intraday movements in this index. So I think, number 1, that's where it can become very, very confusing. This day in particular, which was January 23rd, last Thursday, I want to say, you had, we started out with a very negative number. So many more decliners than advancers, a lot more stocks down versus up on the day. But by the close, it was pretty much even. And so this is the number of up stocks versus number of down stocks. So we started pretty low. By the end of the day, it was positive. So, I think one thing to remember is overall, there weren't more advancers than decliners. Even at the end of the day, it was still kind of a negative thing because it was sort of flat. It was just less negative because you started out having a lot more down stocks, and by the end, there were less and less stocks down than up. By the end, it was about even on up and down stocks for the day. So even though this is going higher, it's not necessarily a positive thing, it's just a less negative thing. And that means 2 very different things. So here we have the advanced decline volume. So volume on up stocks versus volume on down stocks. As this goes up. And as it's more of an even measure of stocks up versus down on the day, the volume picture is going to change. And it's all about the volume on those individual stocks. So when a stock goes from being down on the day to being up on the day, that entire day's volume all of a sudden swings from one side to the other. And I think that's why toward the end of the day, this number becomes a lot less negative, because you have more and more stocks that are not down on the day. All of a sudden that alleviates the negative pressure there. So that is the long answer. My short answer is I don't put a lot of weight on intraday divergences like this. I think this sort of indicator is much more relevant from a longer term perspective, because here you're seeing how a daily indicator is fluctuating from open to close. This is more how I would want to visualize it, which is more of a longer term view. So this is looking at the S&P 500. This is looking at the advancers minus decliners, but now over a daily time frame for the last year. Here we're looking at up-down volume, but again, over time. The way you set up a chart like this is at the bottom, you set up an indicator called price, you put in the ticker, and then make sure you set the style to cumulative. What that's going to do is take a daily read and accumulate those values over time, give you a nice long-term data series. Now I'm looking at apples to apples price versus advancers decliners versus up-down volume, 1, 2, 3 right in a row. What you look for is where there's disagreements like you saw here last September. The market reaching sort of a plateau, advancers decliners sort of a plateau, up-down volume getting negative, which shows there's a lot of profit taking, there's a lot of selling versus buying, and that's what's pushing more volume on the down stocks than the up stocks. Tells you a little bit of a pause is coming. Boy, that was a wordy answer. I hope that was clear to everyone. If not, I'll try to answer it a little better next time. But thanks for that question on up-down volume, advancers decliners. I like to look at it longer term perspectives. That third question came from a viewer talking about institutions and their use of technical analysis. How do institutions use technical analysis? They had heard a lot of institutions do not. So what does that mean? Is it something only individual traders use, or what? I'm summarizing the question very quickly. Here's how I would describe it. The short answer is yes. Many, if not most, institutions use technical analysis in some form. How many of them use the very traditional technical analysis that we're advocating, which is looking at charts, drawing lines, looking for divergences and convergences and all of that? Many of them. But most of them, if not all of them at this point, use some quantitative way of using that discipline. And a lot of times they won't call it technical analysis. They'll call it a momentum factor or some sort of quantitative analytics. What momentum does is it basically looks at a bunch of stocks, thousands of stocks, and it says which ones have done the best, I want to own those, which ones have done the worst over some time frame, I want to underweight or not own those. And that tends to work. That factor of investing in what has worked and underweighting what has not worked, that has stood the test of time. That momentum factor has been proven to be consistent across different time frames, different cycles, different regimes. So overall, that is a way that a lot of investors, a lot of institutional investors use technical analysis, is by having ways of quantitatively calculating price strength in the form of trend following, or what they would call price momentum, and putting some of their capital into place where they're capturing that. I would also tell you, having spent most of my career working with institutional investors, there are a lot of what we call closet technicians out there, people that use charts, wouldn't admit it in their prospectus, wouldn't admit that probably directly to their clients, but they're a big fan of charts, especially when the market starts to feel some pain, because that's when charts can really help you with risk management. So thanks so much for the questions, especially the last one on institutions and how they use technical analysis. We're going to take a quick commercial break. Be back with my guest, Dana Lyons from the Lyons Share Report. See you in a minute.
I was staring at the north wall of my barn.
Okay.
It's 70 feet long, it's about 18 feet high, and just blank. And I said to myself, you know, 2017, I'm going to be 50 years in the business. Wouldn't it be cool if I could just put the history of the stock market? That's where the idea came from. I wanted to capture my 50 years.
Hey everyone, welcome back to the show. Thanks for joining me every day after the close to look at the charts, look at the long-term trends, try to put them in proper context. My guest today is perfect to help us along that journey. I want to invite Dana Lyons. Dana is the founder and editor of the Lyons Share Report, also partner at J. Lyons Fund Management. Coming to us from the Windy City from Chicago, Illinois. Dana, thanks so much for coming on the show.
My pleasure. Thanks for having me, Dave.
So listen, you sent two charts ahead of time, and this first one I thought was really interesting. Given the pullback that we've seen, you're showing how the market top or price level where it was at actually fits into the historical perspective. What are you seeing here?
Right. Thanks, Dave. A lot of people keep asking us about the news events and what these tape bombs that come out and how we should deal with them. We always tell them, basically it's noise until it impacts either our indicators or if it happens at a certain juncture in the market. So why is this virus outbreak so much more impactful than, Iran, U.S. Affair, the drone attacks, impeachment, that type of thing? To us, it's only because it's occurring at a certain juncture in the market, which is pertaining to this Fibonacci ratio that we're looking at. So markets tend to move like many walks of life. They tend to move in measured ratios or certain patterns repeating sequences. And in this case, one of the analysis that we use is Fibonacci, which is a repeating mathematical sequence. Excuse me. In this case, you can measure the distance a market or a ticker often travels once it breaks out above a period of digestion, consolidation, or correction, like we saw, what you're looking at now. So in 2018, for example, the S&P corrected in the fourth quarter. If you take a measurement of 61.8% of that correction and add it to where we broke out, that puts you at about 33.08, which in our view, historically is a pretty reliable indicator of where a rally might not stop necessarily, but it often pauses or corrects or consolidates at least temporarily before moving on. So that's why we took some chips off the table about a week ago. And as this chart shows, we did indeed see the market pull back from that approximate area over the last.
It's really interesting, and I love. There's so many great things that you said in there. Part of it was just, again, I've been asked a lot about just the news flow and how do you deal with it. And I think your point is fantastic, which is until the market actually reacts, right? It's more important to look at the price, see what that's doing relative to speculation about what could happen, right? I mean, you're focusing on what is happening, which is fantastic. The second chart you sent is really interesting because we've often talked about the broad market relative to breadth and sentiment. Your second chart is related to the put-call ratio. It's something we actually don't talk a ton about on the show. What are you seeing here from the options market, and what does that tell you about stocks?
Well, similar to the point and the news flow. So why was this virus outbreak so impactful now? Because technically we're hitting a juncture that was maybe some technical resistance as well with sentiment. We had sentiment that, unlike in the fall, was getting overly bullish or frothy, as exhibited by the put-to-call ratio, which was coming up nearly all-time lows, which indicates an indicator that equity options traders were not that fearful. They were very complacent and more susceptible, not protected against some sort of decline. So when the decline hit over the last few days, they were not protected. That can lead to a rush out of stocks, a rush into hedges, and kind of exacerbated decline. So when a decline happens, we always, like you started your show, we're always wondering, okay, how far is this decline going to go? What is the downside risk here? Is it over? Do we buy the dip now? A lot of times, the most beneficial, at least on a short-term basis for us, the most helpful things to use are measures of sentiment. So we want to see fear levels spike. We want to see put-to-call ratio spike up. We've seen measures of VIX and volatility instruments really spike up and show some fear, especially yesterday. One area we're not seeing a lot of fear right now is in the put-to-call ratio on the equity side at CBOE. In fact, yesterday, if you can see there where the red circle is, it actually declined on the day yesterday versus Friday when traders bought up a lot of calls going into the weekend. So from a perspective of a dip buyer wanting to jump back into the market, that makes me a little bit hesitant and certainly makes me not want to jump in and chase these prices, this rally here today, and makes me think there might be a little bit more to go, a little bit more testing on the downside. That might get this, put the call ratio, the spike a little bit higher, get people a little bit more hedged, a little bit more fearful before it's off to the races again.
Dana, those are two fantastic charts, and for what it's worth, you've convinced me to pay attention to the put-call ratio more than I have been. And I love how, getting the 0.90 level, it lines up so well with when we have had a meaningful pullback over the last couple of years. So two fantastic charts, and thanks so much for coming on, and thanks for sharing those both with us. We really appreciate it.
My pleasure. Thanks for having me.
Folks, that was Dana Lyons, the founder and editor of the Lyons Share Report. Two interesting charts, and especially the one on options. Again, I'm not an options guy, and I've not traded options, but every time I speak to someone with an options background, I leave thinking I should pay more attention to it. So really appreciate Dana sharing some of his expertise there. We need to move on. We're getting toward the end of the show. Did any of you guess what the mystery chart is? What is this ticker? IWC. Okay, that's the microcap ETF. Good guess. Congratulations, Team Final Bar, as always. Impressing. Really doing well. That is correct. IWC. That's a microcap ETF. What I love why I love to show this is because I find it's off of people's radar. Things like microcap stocks, the frontier market. These are things that people don't tend to think about because they're relatively newer. They're not as widely covered. And again, smaller, more speculative for sure. However, I like looking at things that are less widely covered because you could argue that's where a lot of the signal can be. So in this case, if you, again, forget about what's happening in the world around you, just purely look from a technical perspective at what you're seeing here. You see higher highs in price, lower peaks in the RSI, a bearish divergence. You see a breakdown below the most recent previous swing low, now a bounce and potentially a pullback. We'll have to see where this goes, but we're right at a key support level. And you also have the relative strength going down for the first 3-4 weeks of the year, certainly for the last 4 or 5 weeks of trading. So overall in microcaps, which should be sort of a more speculative, more risk-on space within the market, you have more negativity than positivity at this point. In this chart, I think looking at the previous low and whether we are able to hold that is important, point number one. Number two, do we break below the 50-day? Number three, does the RSI remain above 40? Those three things altogether tell you whether or not microcaps are suggesting a bit of a short-term bounce or if this is the beginning of a deeper sell-off. So congratulations, good guess. IWC is absolutely right. We need to wrap the show, folks, which is going to the 3 in 3. At the end of every show, 3 charts in 3 minutes. We'll be a little less than 3 minutes today, but we're going to get through it. Chart number 1, this is the S&P 500 and breadth in the form of stocks above their 200-day, stocks above their 50-day moving averages for the S&P 500. What's interesting here is we were up at about 85% of stocks in the S&P above their 200-day. That's come down dramatically to around 73, 74%. So, we've come back to more reasonable bull market levels. This is actually the level most recently where we've topped out, where we've had a bit of a pullback. What's more interesting to me, though, is the fact that the percent of stocks above their 50-day moving average in the last couple days has come down almost 30%. So from 83% down to 55%. That is a huge jump, a huge change, which usually happens during big corrective periods. So it'll be interesting to see how many stocks continue to sell off, pull back, and fail at their 50-day, which for a lot of times ends up being a good, decent pullback objective. Chart number 2, very quickly, global regions. So if you look going back to the October market low, sort of a short-term swing low in the markets, and go to now, the S&P is once again the leader, up 14%. Frontier markets up number 2, almost 11%. EFA and EM around 10%. EM had been the number 1 of the 4 in the first couple weeks of the year. That has changed with the weight of commodities for emerging markets. I also wanted to point out in a market analysis, this is just year to date and what's been working. It's interesting to note that bonds in the form of the TLT up 5.5 to 6%, followed by gold up 3%, followed by the dollar up 1.8%. Fourth in line is the S&P 500 up 1.5%, and the lowest is, not surprisingly, oil. So interesting to point out, even with all the thinking of stocks and everything, they are now 4th out of the 5 major assets that I would be looking at with oil at the very bottom. Ladies and gentlemen, that is our show on a Monday afternoon. Thanks for joining us every day. Thanks for sending those questions. Those all came from our viewers. Keep them coming. The Final Bar at StockCharts.com or on Twitter at FinalBarSCTV. Our documentary tomorrow featuring Ralph Acampori, you're not going to want to miss. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a good night.